Hi, this is Ray Hoffman, and this is part 2 of my CEO radio conversation with the CEO of by far the biggest credit rating firm to be founded after the mortgage meltdown and Great Recession, the Kroll Bond Rating Agency. And Jim Nadler pulls no punches in saying the old Big Three credit firms, or the incumbent firms as he likes to call them, could have headed off the mortgage crisis and the meltdown had they been a little more diligent about doing their job. There's a lot of information here. Hope you have time to listen to it.
There were about 40 rating agencies that were started globally after the crisis. If you added up all of the revenue of all the other rating agencies that were started globally, it probably wouldn't equal half of ours. So we have been by far the most successful post-crisis rating agency. And because of that, and because so many of the regulators, the regulatory bodies are interested in more and better competition, we've become the rating agency that they look to really bring this competition to the incumbent rating agencies.
And you just moved into Canada.
And we just moved into Canada. We just got approved in Canada. And so we expect to be doing deals in Canada probably in the fourth quarter of this year.
On your website, it's interesting to note the two quotes that are posted within your bio and that of Jules Kroll, the non-executive chairman. In his bio, there's the quote, "We are answerable for the accuracy of the calls we make." And in your bio, quote, "In the market as in everything else, truth matters." So I'd like you to think back to when you were interviewing for this position, and what did Jules Kroll want to know from you?
We hit it off immediately, and he hired me on the spot. And I think that we were like-minded, and I think that Jules is a very open person, very interested in this notion of transparency and being true to a creed or a set of values. And when we were interviewing, we talked a lot about that, about setting standards and then being true to those standards. And I think that's why we hit it off so well. I think we both had the same idea of the things that were important in a rating agency.
When you interviewed at another rating agency many years earlier, did you go through the same kind of talk?
No. No, I think they needed people really badly, and I happened to be standing in the right place at the right time.
Okay. What in your background at the end of the crisis appealed to him particularly?
You know, I think it was that I had been on the buy side, but also I had been at Fitch when Fitch was recapitalized in 1989. So in essence, I had been at Fitch and helped build Fitch from a very small company that had about $1 million in revenue in 1989. And today I think Fitch has $1.3 billion in revenue, or $1.2 billion in revenue. And so I think he liked the idea that, because it's not an industry where there have been a ton of companies started in the last few years. And so I think he liked the idea that I had been at a rating agency that really had just started in the late 80s and had helped build that. And so we talked a lot about what the playbook was, and I'd seen what to do and what not to do. And so I had a great training ground, and I think that appealed to him too.
And what have you learned from him in the subsequent years?
I think that as much as Jules learned the rating business from me, I think the thing that I learned from Jules was just his ability to connect with people. You know, Jules, when I met him, he had a vast network of people that he knew and we could get in front of and talk to about different issues. And I learned how important staying connected was with Jules. And so I've sort of adopted that. And I never was that kind of a person. I was always somebody who, when I was off to do something else, I was off to do something else, and it was new, and I forgot everything I'd done before. And I really learned from Jules how important it was to keep this sort of connectivity. And so I've sort of changed the way I behave because of that.
As the company is built out into different areas, can you give me a sense of the way you approached the build-out?
We did it with a couple of different things, and it's not rocket science. We listened to investors, and we did solid research. So everything we did was on solid footing. So I'll give you a great example. Prior to us being in the business, the incumbent rating agencies didn't really rate a bank that had less than $10 billion in assets. And I always thought, maybe they're right, maybe they're wrong, but I've never seen any research that proves it. So I said, well, the financial crisis gives us a great set of data to look at and see if that's really true. And so we did a extensive research project and looked at how banks fared during the crisis. And we found something very interesting. It was the very large banks that had problems and the very small banks that had problems, say under $750 million in revenue. This mid-tier, this $2 billion to $25 billion in banks, the large community banks and small regional banks, did great during the crisis. They're largely deposit funded, they know their customers, and so we started rating them. And it's been a tremendous business for us. It's opened up a great source of capital. It lowered the cost of capital for many of these financial institutions. And as you know, community banks are the backbone of the United States economy. And the other thing that it did was it got our competitors interested in looking at these banks. And so we approach every area with that same approach. We listen to investors, and we do our own primary research on the area, and then we use that as a basis for rating.
And how much do you think about market share?
I'm very competitive, so I think about market share a lot. But I think of it more in terms of us doing a good job in an area and building on that market share. So I don't like overnight market share, and I'll give you another example. Early on, our first year, we were approached to rate re-REMICs, which are repackaging of the lower rated tranches of residential mortgage deals. And our residential mortgage team looked at them and said, we can't rate them. And it would have been great to be posting revenue in those days, but it was quick money, and we couldn't do it. It wasn't the right thing to do. It wasn't right for investors. Those deals all got downgraded within a year or so. And we take that same approach with everything. And so I'm not interested in building, revenue very overnight. I'm interested in building solid revenue, making solid connections with our customers, and then building on that. And this bank, the bank business, for instance, we started that 3 years ago, and now we're up to 120 banks. And we built that slowly, but it is a solid business now, and now we've got banks coming to us because they like our research, and even bigger banks coming to us because they like our research. That's the kind of business that I like to build. So I think about market share, but I think about it over the long term, not in a short-term way.
Yeah. Would you now consider yourself, in terms of market share, a solid number 4 or a terrier nipping at the heels of the 3 or what?
I think we're all of that. There are a number of areas, aircraft, for instance, the aerospace industry, financial institutions, airports, PACE, the solar energy-backed deals, where we are a leader in those areas. And so we have the largest market share. We're the thought leader in those areas. And there are other areas where where we're just working our way up. So from a overall market share, we certainly don't look anything like our largest competitors. But if you look at our growth, and we're growing at 25% a year, we're already nipping at their heels, and it won't be long before we'll be taking significant market share from them.
And how big should this company be in your mind?
I think what's interesting is that we'll do about $120 million in revenue this year, which, when you think of it from a standing start 8 years ago, is an incredible feat. You look at it in comparison to our largest 2 competitors, Moody's and S&P, and it's a drop in the bucket. And so I think that we'll continue to grow for the next 20 years, long after I leave, because there's a lot of room for us to grow. But we'll grow healthy and in a solid way, and we will continue to provide for our customers everything they need, and we'll build on that. And so that growth pace is great for that's the type of company I want to build.
And what do you enjoy most about this job?
The people. We've got some of the greatest people. I work with tremendous people. Our clients are wonderful. We have such a great relationship with each of our clients. A lot of times when we go visit clients, it's like visiting old friends. And so that's really what I enjoy the most. It's been fun. I'm addicted to startups, and this is my third. And this has been by far the most fun and successful one that I've been a part of.
Tell me about the other startups.
So I was at Fitch when it was recapitalized. I left in 2001, and they obviously have done well. And then I started my own independent research firm that I ran for 3 years, and it was bought, and it was a moderate success. It wasn't a name that you would recognize, but it was fun. And then this is my third one. And
I'll take the name, though, if you want to give it.
It's called Criterion Research.
Sounded great.
And this has been by far the most rewarding, not only from a growth standpoint, but just the incredible number of people that I've gotten to know in building Kroll.
And since the credit markets are almost always ahead of the stock market when it comes to sniffing out trouble in the U.S. economy or trends in some part of the economy, what are the credit markets telling you as of August 2018?
It's interesting. You read a lot about the subprime market maybe getting a little soft, and certainly we're seeing in some areas delinquencies are moving up a little bit. We're always watching non-investment grade corporates, and there seems to be a really frothy area. There seems to be a lot of money chasing yield in that area. But I will say that one of the things that I'm very optimistic about is the financial institutions in this country are in the best shape they've been in years. They have raised significant capital over the last few years. So when you think about systemic risks, and you look at the crisis that we've had in the past and other crises, you think about, well, they went from whatever asset class or whatever to the banks. And I think that the banks are in great shape, at this time, and could withstand a shock in an asset class or in a sector of the business. So I'm actually fairly sanguine about the fixed income markets. We're certainly always on the lookout for things that we need to be aware of. And in fact, one of the things that we do as a company is we spend a lot of time looking at surveillance in each of the different areas. And we use that as our feedback loop. Well, how are we doing? How is the residential market? Are people paying their mortgages? How is the auto market? Are people paying their autos? How are the banks doing? What do their margins look like? And so we get that data every quarter, and or in some cases monthly, and we're looking at it all the time. And so we're always on the lookout for the next sort of thing on the horizon. Right now, though, everything seems fairly benign, and then, as I said, I'm optimistic because I think the general financial institutions are, generally speaking, in really good shape.
Now, do your competitors engage in the same sort of quote-unquote surveillance?
I don't know what they do, but I will tell you that had they been doing it in the crisis, that we wouldn't have had the crisis. I assume they didn't do it then, and I'd be surprised they were doing it now.
Now, your work is designed for clients and institutions, but I'm wondering, is there anything that individual investors can use to gain advantage from all this Kroll research?
Certainly, I think that many of the financial institutions that we rate, in many cases, we're one of only a few companies that write about them. So even if you're an equity investor in those banks, you may want to look at our research, and our research is all free. You can get on KBRA.com and put your email address in and be able to pull the research down. We also do a lot of research in municipals, and many individual investors invest in municipals. And so we have write-ups on the city of Chicago, on the state of Texas, on the state of Connecticut. And retail investors are certainly welcome to come on our site and pick up that research and look at it.
I have to read your research on the state of Connecticut, being a Connecticut resident.
It's good research.
And it's not a very pretty picture either.
Connecticut's got some challenges like many municipalities, but municipalities are unique. They're not like companies, and I think we learned this when I think you probably remember the Meredith Whitney interview on 60 Minutes, where she said, oh, the muni market's going to fall apart, and then it didn't. And I think it's always good to remember that the public finance market has many more levers to pull than a company does. They have ad valorem taxing power. They have, so they have all these other things that they can do that we certainly, we need to be concerned about pensions and pensions that are underfunded. We need to be concerned about the debt level that states have. But we also, when we look at property values, for instance, in many of these states, there's room to continue, and I know Connecticut, you don't want to hear Connecticut raise taxes, but my only point is they do have levers that they can pull to maintain their credit rating and maintain their sort of credit standing that a company doesn't have, yeah.
So you're enjoying yourself in this job.
I am having a good time, yes.
Continued success, Jim Nadler.
Thank you. This has been great.